Let's be honest, the stock market can feel really complicated, right? But what if I told you the path to building wealth is actually surprisingly simple? In this explainer, we're going to break down exactly how anyone can get started. Let's get right into it. To really get the most important rule of investing, I want to start with a story. So picture this. You start investing in 1985. For 2 years, things are looking great. And then bam, catastrophe. They called it Black Monday. It was the biggest single-day drop in Wall Street history. Absolute panic. And it didn't just stop there. The investor in our story, he lived through that, and then the dot-com bust, and the 2008 financial crisis, and the global pandemic. We're talking 4 massive market meltdowns. After every single crash, you can bet his friends in the news were all screaming, "Get out! Sell everything!" But he didn't. He just held on, watching the market dip, then recover, and then, every single time, climb to brand new highs. So, what's the big takeaway here? It's that resilience. He never ever panicked. He didn't try to be a genius and predict the market's next move. He just stayed put. So after all those years of holding strong through the chaos, what was the result? Through all of that drama, from 1985 all the way to today, his average return, year after year, was over 11%. Now, to put that in perspective, your typical savings account might give you what, maybe less than 1%? This is the raw power of the market's growth over the long haul. Okay, so an 11% return sounds good, but what does that actually mean in real money? Let's say our investor wasn't some Wall Street tycoon, but just a regular person putting aside a pretty modest amount, say $250 every month. Well, that simple, consistent $250 a month would have ballooned into over $1.8 million. That is a return of over 6,000%. This isn't magic, it's compounding. It's where your money starts making its own money, and it just snowballs over time. So how on earth is that possible without being some kind of stock-picking genius? Well, the secret? It's a strategy that's actually as simple as following the music charts. Here's the thing. Trying to find the next big company, picking that one winning stock, is incredibly difficult. Even the pros get it wrong all the time. This is the exact opposite of that high-stress day trading you see in movies. So instead of trying to find that one golden needle in a giant haystack, the best strategy is to just buy the whole haystack. And this is where something called an index fund comes in. Think of it like a basket that holds tiny little pieces of hundreds of different stocks. So, for example, an S&P 500 index fund gives you a little sliver of ownership in the 500 biggest and most successful companies in the US. You're not betting on one company, you're betting on the entire American economy. And this music chart analogy just explains it perfectly. An index fund works exactly the same way. A music chart automatically shows you the most popular songs, right? And if a song stops being popular, it falls off the chart. Well, an index fund automatically holds the top-performing companies. If one of them starts to do poorly, it eventually gets dropped and replaced by a new rising star. It's a self-cleaning system. This whole approach is just perfect for beginners because it's completely hands-off. You get what's called instant diversification, which means your money is spread out, protecting you if one company goes bust. It's super low maintenance because the fund does all the adjusting for you. It's got resilience baked right in. Okay, so that's the big idea. Now let's get down to brass tacks. Let's turn this into a dead simple, actionable plan that puts your wealth building on autopilot. Getting started really just boils down to 4 steps. Seriously, that's it. This isn't about complicated charts or stressful trading. It's about setting up a simple, automated system that does all the heavy lifting for you. First step, and this is a total game changer, is opening an account that literally shields your money from taxes. If you're in the UK, it's called a Stocks and Shares ISA. If you're in the US, it's a Roth IRA. With both of these, all your profits can grow completely 100% tax-free. That is a massive advantage over the long run. And the real key here is automation. The son of one of the investors from our source material actually ran a little experiment. He set up an automatic investment of just £5 a day, about the price of a fancy coffee, into an S&P 500 fund. It's just a powerful way to see that you don't need a ton of money to start. You just need to be consistent. Okay, here's a little pro tip to make this truly set it and forget it. When you're picking your index fund, look for the word accumulation. See, some companies pay out their profits to you as cash, which are called dividends. An accumulation fund automatically takes those dividends and uses them to buy more of the fund for you. It basically puts your growth into overdrive without you having to lift a finger. All right, so you now know why you should invest, what you should invest in, and how to do it. The only thing left to do is to actually start. And I'm telling you, the data is crystal clear. Waiting is incredibly expensive. Just take a look at this. This chart shows the absolutely staggering difference it makes if you start investing a regular amount at age 25 versus waiting just 10 years and starting at 35. That decade of lost compounding growth, you can never get that back. Your single greatest asset isn't your stock picking skill, it's time. The strategy couldn't be simpler. The tools are out there for everyone, and the cost of doing nothing is huge. The history is clear. The winning plan is to start small, stay consistent, and let time work its magic. So the only real question left is, what's that first small step you can take today?